So Sunil, good to have you back. Good to see you smiling. Sunil, let's try and attempt to divide the market in three parts. Based on the kind of moving parts we are, what to your mind has changed in the short-term market outlook, in the medium-term market outlook, and the long-term market outlook? Because suddenly we are staring at a maze of issues which were unanticipated or unexpected at the beginning of the year.
So Nikunj, frankly, every market correction definitely is not something which is joy. So I think the smile is because of the experience we have in seeing these kind of scenarios emerging time and again. You know, it's not a smile at the cost of investors who are seeing near-term drawdown. But, you know, having said that, I think you're right. We have seen a lot of events play out over the last few months. Obviously, inflation, interest rate worries, upcoming state elections were already known. I think the new joker in the pack has been the scenario which is emerging pertaining to Russia and Ukraine. And I think I would say that over the last 3-4 months, the markets were looking at some kind of reason to cool down a bit. Obviously, you know, the cooling down a bit has got a little bit exaggerated, particularly in the broader markets. But all these events were sort of, in hindsight, a reason for the markets to cool down. So I think in the absolute near term, yes, the market momentum to some extent has been broken. So it will take some time. I think we are in a consolidation phase. We are not very negative in the market, frankly, even in the near term. But it will take some time for it to recover its zesto. I would say that traders particularly would like to wait even for the state election results to come in towards the mid of March before taking any strong positions. And generally, March is a sort of a softer month because, you know, advanced tax payments go, and then there are margin funding which sort of gets a little bit difficult in the month of March. There are new margin guidelines coming in for FNO. I think that would lower the volume. So I think in the near term, we are in a range-bound moment. But frankly, from a medium to long-term perspective, in fact, we have got more positive. And I'll give you the reasons. One is at least our view is that oil is heading towards 70 and not 110 or 120, maybe by June, July. It's a combination of a lot of things. One is the winter season is getting past us, and the demand for heating gas in particular will reduce quite significantly. Second, obviously, is the fact that at least our view is that this Russia and Ukraine crisis, whatever has to happen, will happen in the next 10-15 days. It's not going to drag on for the next 3-4 months. And at least $20 of oil price increase has been because of this particular event, and that should ease off. Third is obviously, you know, the US also doesn't want the bloc led by Russia to become stronger, and they would also like oil prices to come down. And there is a big probability that Iran might be allowed to pump in more oil. And most important, which all of us have missed, is that shale oil production, which had fallen quite significantly because oil had fallen to like $30-40, in fact, negative also at some point of time. Both in both in Canada as well as US is now inching up to record highs. And I think we know that what happened when the last time shale oil production increased quite dramatically. And I think we are seeing that. So from a 3-4 month perspective, we see oil correct quite significantly, and particularly for India, that would be great. The other thing is that, you know, now if you look at global investors, you had stress in China. You have the Evergrande issue, the real estate clampdown, then the digital clampdown, then the education clampdown. Investors lost a lot of money in China. And the wounds are very fresh. And obviously, China is no more a very attractive destination for them. And now the same thing has happened in Russia, where, the index is down 30%. It is down as much as it was in the first phase of COVID. And therefore, I think it is very clear that democracy and stability, which is what India provides, would lure investors more into stable countries like India rather than other. And the most important thing, I think, Nikunj, which most of us have missed out, is that rupee, in fact, has appreciated since the Russia-Ukraine crisis blew over. So from 75.75, we fell to like 74.5, despite the fact that crude went up to $99, and despite the fact that there were other currencies which were swinging very widely. And that again clearly highlights the strength in the Indian economy, And from a global investor's perspective, I think that is a phenomenally positive thing. So from a longer term perspective, I would say on the macro level, we are now more positive than we were.
Great. So you've simplified the short term, medium term, and the long term outlook. Now, given that the market also have seen a shakeout, internet stocks have got smoked, corporate banks have got re-rated. So while your outlook is clear in terms of the sectors and in terms of the preference and where you see the shape of the economy is moving, how are you placing your bets? I'm asking you this question because let's say if your portfolio positioning, which was centered around metals, few IT names, will you be thinking about changing that?
So the core portfolio remains almost the same, because we don't invest from a 1 month, 2 month perspective. But incrementally, as I said, our view, because of oil view being a little bit soft, and because of the fact that we believe that post the huge stimulus for spending in the budget, obviously there will be a little bit of more, tilt towards the capex side. One more segment which we are incrementally getting more and more excited about is the domestic brand and the domestic consumption play. COVID is behind us. It was very quick. The concern over particularly COVID-3 has allayed very, very fast. We are seeing record number of weddings, record number of events being organized. And these are sectors which are not getting impacted by what is happening globally. So I think domestic-oriented sectors, some domestic brands are a place where we are incrementally getting very positive, and we are adding wherever we are getting opportunities. The good thing is that the markets have corrected like 5-7%, but the broader markets are down anywhere between 10 to 30%. And you're getting opportunities also. And luckily for us, we are sitting on a lot of cash, one out of the new fund which we raised, and also some cash which we had raised in the older funds. So I think it's a good spot to be in. And as I said, we continue to be quite optimistic. Even in the near term, we feel that the fall is behind us. But from a medium to longer term perspective, these would be a few themes and sectors where we would be incrementally very positive. And even on the digital front, I think the world has just slammed them. We don't invest overseas, but even overseas names like Netflix and Facebook have now come to levels where even on a P basis, you can justify them. And even in India, we have a few names on our watch list. Hopefully, if we get some more correction there, we would definitely be buyers.
Sunil, you've had investments in IT in the past. Wanted to understand how is it that you're making sense of the correction that's played out in IT? I mean, are IT stocks to be correlated? Because it's not an apple-to-apple comparison between what's happening with FANG stocks on the NASDAQ to IT stocks here. Did they fall under their own weight, or is it now a serious case of that, the low-hanging fruit gain days are behind us, and now you may see a sporadic incidence of some re-rating here and there, but the good days are behind us?
So Aisha, markets are never fairly valued. They go into swings of deep undervaluation to deep overvaluation. I think in IT also you saw that. The large cap IT companies were trading at 10, 15 times with very decent trajectory of growth. And the mid caps were in fact in single digit P. And then you had phenomenal growth which happened during the last 18, 24 months. And you saw, a lot of stocks move into an overvaluation kind of arena. In mid caps, in fact, there were some companies which are also, I would say, in an exuberant kind of a zone. And that correction, largely, maybe the reason was the sharp fall in the digital world and NASDAQ and so on and so forth. But as I said, they needed a reason and they have corrected. I think at this levels, we are quite confident that IT services as a sector will give decent returns. Obviously, they cannot give you the kind of phenomenal returns which were given last 2 years. But even if you factor in the fact that these companies and some of these, a lot of these companies will grow 20% in terms of their profit, I think even if you are able to get returns which are commensurate to the profit growth, it's a very decent 18-20% return which we expect from these companies. And I think we continue to be quite optimistic and overweight on this sector.
So, I was reading, preparing for this interview, that in the December quarter, you raised stake in 12 stocks and reduced holding in 9 companies. And the one where you have really increased your stake is Sada Energy and Minerals. Why is that the case?
So one is, I think all these articles, even if we have some little bit of adjustment, 2 basis points up and down, the headlines will basically report something which is hardly of any consequence. So I think you should ignore it. The normal tweaking of positions is an ongoing process for any fund manager. I don't think we have done significantly change our exposure. And anyway, I think it's our job to keep on looking at new stocks. I don't like to talk about individual stocks, but I think that article, frankly, is something which is not of too much importance. Even if you ignore it, you will not lose anything.
Right now we are worried about inflation, but at some point in time inflation will start peaking out or start reversing. The beauty of market is that you have to plan your investments before the actual event occurs. Is it time to go back now to inflation consumers rather than associating with producers? Because whenever inflation turns, margin picture will change, dynamism, pricing will also change. Is it time, let's say, to buy autos, paint companies, cement companies?
So, Nikunj, I think we don't see a scenario where commodity prices will fall very sharply. Yes, some commodities like oil, which have risen very sharply, might correct back to 70 levels, which I mentioned to you earlier. Because, but the normalization in inflation will be largely a base effect scenario. So I think economics to that extent is quite funny. Suppose if something moves from 80 to 90, you have 12% rise, and then 90 stays at 90, your inflation becomes zero, despite the fact that the price has not fallen. And I think going forward, you will have that scenario. So right now, inflation is very high because the base was the COVID period where prices were very, very low. So on that base, obviously, inflation has to be high. Oil from 40, if it is 80, inflation is very high. But if this 80 stays at 80, inflation will be almost zero. So inflation will stabilize or come off largely because of base effect. Having said that, yes, the prices not moving up or slightly reacting also should be positive for consumers. Having said that, we are obviously quite positive on the domestic oriented sectors. Maybe, cement, which is getting impacted because of higher coke prices. Steel, at least in this quarter, December quarter, and maybe in March also will get impacted by higher coke prices. They will start to normalize. As far as other sectors you mentioned, I'm very sure that margins for them also will inch up. But you mentioned paints. I think that sector is priced beyond perfection. And you already have, now Grasim has already announced their foreign paints. JSW Group is already in paints. I saw news yesterday that JK Cement Group is also looking at paints. So when valuations are so high, I think a lot of companies would be enthused towards launching their own variants of paints. Yes, it's not going to be very easy, but at the valuation and headwinds in terms of higher competition, we would stay out of that sector.
Appreciate your time. Keep smiling, my friend. That is what is important. Stay happy, keep smiling. Doesn't matter what markets are. Appreciate your time.